Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm your guest, Jake Fugman, with my partner, Michael Scanlon, and as always, your hosts, Tom and Mark.
All right, man. I will take that.
Nice work, guys. You can tell they've been on a few times.
Yes,
so
for sure.
Ready for it.
Or they might have listened too. So.
Yeah. Happy New Year.
Yeah, Happy New Year. This is the first time recording, January 2nd. Like I'm excited about this year. I do see a big year, especially after, I don't know, did you see Jason Wagner's post he put there about the inventory and how much it's gone down? We'll talk about that here.
And we'll talk about it in this episode as well.
I know, but I think that is such an opportunity, especially for house flippers this year, in the sense of like, just without the inventory, you're just going to have artificial highs.
Yeah, when things are hard, that's how you make money. You find a way to do it.
There's going to be a lot of people that will check out in 2026 because they can't find a deal or they give up after 6 months or they're working with the wrong real estate agents. But that is definitely an opportunity for the rest of us.
Yeah, absolutely. So we went. I know we went long on this one. So why don't we just jump into our housing provider tip of the week?
My tip here today is don't hide in the preparation. It's always easy to say I didn't watch enough podcasts, I didn't read enough books, I didn't go to enough meetups. But take some action. Don't hide in the preparation. If you're watching this right now, there's a good chance that your feed or you're listening to the podcast, you've listened to a lot. You know what you have to do next. So make sure you're taking advantage here in 2026 and do more. Time's going to run out no matter what for you at some point, and how much you get done is up to you.
All right. Love it. Bringing our guest today. Man, hey, I think we mentioned all the episodes, but have multiple times. Friends of the pod. Just absolutely two great brokers. If you're not familiar with them, please get to know them. They can absolutely help you on your journey. Without further ado, from the Axon Group, we have Jake Fugman and Mike Scanlon. Welcome back to the Underground.
Let's keep doing it. Love it.
Yeah.
I think they're the first ones to be in the Underground 3 times.
Ooh, that's a lot of Underground.
Yeah.
And we kind of came late, too, so that's a testament to the consistency.
Yep.
Let's do
there
it.
you go. For our listeners, though, Jake was an OG. He was on episode 20. That's forever ago. We were just talking about COVID. It was in the heart of that. You were on the panel with us for 200. Then you guys also had a bunch of Tuesday tips I'm not mentioning, but then we did the 2024 predictions on episode 268 and the 2025 predictions, which we're going to talk about on episode 354. And then now we are at episode 4-something. So welcome back, guys.
Thank you. I'm not worried at all about the fact that I haven't had my own individual.
Yeah, no. We're easing you in, man.
Yeah.
All right. So, we'll showcase some of your insights here, because you guys did get a lot of your 2025 predictions right. I think we did better this time around than last time. 2024,
Because we made them a little vague. They weren't like bold predictions. Again, like very objective. We were like, things are looking okay in Chicago. And, here we are.
Yeah. All right. So let's walk through it. So, Mike, the first one you made, you were talking about the election fallout and bonus depreciation. That was going to have an effect, and maybe take a step back and explain bonus depreciation on the cost side for our listeners and talk about the prediction and what actually played out in 2025.
Yeah. So we were in a trend last year where we were going down 20% per year in bonus depreciation. Now, again, it's a much larger topic on, how bonus depreciation works. But basically, now that we're back to 100% bonus depreciation, you can accelerate more to the first year. And you can get a larger write-off in the year that you buy a property. And my prediction last year was that, given the real estate background of the current political landscape, obviously Trump being, more of a real estate guy than, most of the Democrats, that he was going to make sure that 100% bonus depreciation came back, and that would hopefully stimulate investment and, a lot of people buying in. And, given that there's a lot of other factors in the market, whether or not that 100% bonus depreciation has stimulated activity just yet is still kind of to be seen, but we did see it reintroduced. So any properties that were purchased, I believe, after January 26th of 2025 are retroactively able to use 100% bonus depreciation, which is great because I bought on January 30th and then subsequently bought a property later in the year. So I'll be doing 2 cost seg studies on those this year. And it should be very beneficial for anybody that can, claim real estate professional status or, use a short-term rental, depending on your level of involvement. And so, yeah, we did see that reintroduced, and I think that it should start to stimulate a little bit more activity for some of our investors, especially with some of the rate cuts that the Fed has done, affecting some of the commercial rates.
Yeah, I personally, I've talked to cost segment Kev way more this year than I did the year before, right? Like, it makes more sense now. Someone like us in this room here are professionals. Like, that 100% is a huge it's huge. Like it's amazing like how much that can change your taxes.
Yeah. Yeah. And if there is anybody out there that is unsure about whether or not they can claim real estate professional status, there's a lot of unique ways that you can go about it. And I know that this is a prediction show. I know that we're recapping, but just as a tidbit of advice, I'm going to bring up a particular client that I have that has bought 3 multifamily property with Jake and I, and they are considering a scenario that I talked to them 2 years ago about, where they are expecting another child and they want, one of them to take the year off to basically raise the child rather than having to, pay for daycare or all of that. So it provides this perfect scenario where for a year, rather than them both having their professional jobs and not being able to claim real estate professional status, for this year alone, they can offset some of the loss of income that they would have had from her not working her job by her now managing those properties and offsetting his income for this year. And so there's ways to get creative with it. There's ways that you can, use short-term rentals to get a little bit of extra tax savings. But of course, if you are a real estate professional, makes things a lot easier. And for, all of us, talking right now, it is something that we can do and offset all of our income.
Yep, absolutely. And from we'll move on, but from those who are interested, we have Cost Like Kev on the Build Your team. We also have several accountants. They can help you with this.
He has a calculator on his website too. Plug him again. We just constantly like to plug.
Yes. So, all right. Next one, leasing vacancies would decrease. We were right and wrong about this.
Yeah, so I'll take that one again, and I hate to take it from Jake, but that was one that was heavily discussed. And so we talked a little bit about what was unfolding very quickly last year, because as we were discussing last year, everything was brand new. The election had happened, but we had just seen Trump come into office. There were tons of executive orders that were being discussed that were already, being signed. And so we were trying to make rapid speculations into what would happen. And one of the things that Trump discussed heavily was, hey, people need to get back to work. They need to start going back into the office. And so whether or not that happened depends where you are. So I did a lot of research into this, and there are a lot of mid-market towns that have seen recoveries, towns, cities. I hate to call Pittsburgh, Kansas City, Minneapolis towns. They are cities, but those areas, those mid-level population type cities did see recovery. A larger city, New York, because of the nature of New York, it's so walkable. There's so much public transport. There's a lot of people going back to the office in New York, and New York has seen a major recovery. But of course, we're in Chicago. So what happened in Chicago? To my surprise, we are worse. We're actually quite a bit worse. So we were hovering around 22% office vacancy last year. So when I looked into it, I was expecting that we would be 18, 19%, which was where we were at in 2023, that maybe we would have a little bit of a bounce back. And to my surprise, we are hovering around 26% for, in the current market. It is not something that has happened here. We do have a little bit less public transport than somewhere like New York. We have a lot more traffic than areas like Minneapolis, Kansas City. So I don't know how much those overall factors of the way that Chicago is set up had to do with it, but we are not seeing the same level of recovery to this point. And so I would say for Chicago, I got that prediction wrong. I relied on some rhetoric that was being put out there by the current administration, but it has recovered slightly in different parts of the country. San Francisco is definitely not recovered. San Francisco and Dallas are the 2 worst cities from what I read in terms of having rampant vacancy, but Chicago is up there. We are not doing well. And I don't know if there is anything that's going to stimulate that recovery at this point, or if we're just too far gone.
Well, I figure we're just going to get a whole bunch of healthcare and daycares like Minnesota. That way we can take care of this commercial problem.
Into those vacancies.
It's not too soon, right?
And this thought I just had, do those vacancies affect the value of those commercial office buildings, and thus why a lot of these assessed values, the argument in Chicago was a lot of that shift, that burden went from commercial to residential, like the Trump Tower and the
United building. Did you see how much the United building, United bought that building, I think 5 years ago, and how much it sold for? Like it was like 20%.
So until those can come back,
crazy.
That's one of the only things that's probably going to help us move that back from residential to commercial burden when these office buildings kind of fill up.
Yeah, well, and there was the big debate with the mayor's budget wanting to tax, and like this, the alderman stood up, and I agree with them. Like we cannot make it harder for businesses to come here. Right. When you do that, like it comes back to you as the homeowner. Like your taxes are going to go up if it's not coming from these major corporations.
My biggest fear with that head tax was just, even though that wouldn't hurt too many, it's just that's what people remember when they think
optics.
about coming here. Yeah, like how that looks. Like what if they do that? What else are they capable of doing if we move our business there? And that's what scared me the most about that passing.
Correct. All right, let's move on. Kind of a layup one here for you. The Northwest Housing Ordinance was going to have an effect on multifamily in the area.
Yeah, and speaking of, like slippery slopes, and that was the thing we were worried about. Like, is this, number one, like what's going to happen? And is this going to eventually trickle into other neighborhoods? It's just like the, tip of the iceberg, so to say, which we don't know that yet. But, we can say, spit out some facts that happened specifically in Logan, right? The prediction was that prices, demand, and kind of velocity of sales would go down. So half correct, right? Prices did not really go down. They did go up slightly for 2 to 4 units. They went up about 3% over from September 24 to September 25, which relative to the rest of the city, 2 to 4 units were about 7%. So that's lower, right? Like prices didn't plummet, right? But inventory was still crazy low. We had 311 new listings in the Logan Square area, down to 233 12 months later. For 2 to 4 units. So that's a pretty heavy drop. Is it because people are scared of the ordinance? I don't know, but the point is, inventory is still tight, and this is not helping. People are kind of scared to release things. There's just a bigger roadblock to getting them on the market and getting them potentially sold. Closed sales went from 164 to 139 in Logan for 2 to 4 units. But we also talked about 2 to 4 units, not having as big of an effect as the 5+, because the 2 to 4 units, it was a 15-day notice for a 1 to 2 unit, not that big of a deal. We talked about if half of the tenants waived their right to purchase, it nullifies it. Just, if you have a good relationship with 2 tenants in a 4 unit, you're there, right? 2 out of 3 in a 3 unit, you're good. But the 5+ units were going to be tougher, right? So I looked into the 5+ unit sales specifically in Logan. I'm just shocked that these numbers were this low. Maybe I got to dig a little bit deeper, but based on MRED stats, in 2024, there were only 12 5+ unit sales. In 2025, 6 5+ unit sales in Logan, which is crazy. That's
nothing.
That's a 100% drop. That is just the 5+, and that's something, again, do we know if that's the sole reason? Probably not, but inventory still sucks. These owners have less motivation to sell because these buyers aren't going to need to come in and build in these super long contingencies. So we'll see what that leads to. But the other half of that ordinance was the tear down permits, right? And new construction. So I didn't pull the construction permits. I really need to get a Cityscape subscription. But new construction, new listings were down from 150 to 72 in Logan over a 12-year period, 12-month period. So again, inventory way down is a result of this, TBD, but it's just not helping. Prices relatively flat. So it's hurting owners in general, right? We're seeing that for sure. Is it benefiting tenants yet? Have any actually? I couldn't find a stat that any of tenants have actually successfully exercised the first right of refusal. So as far as I've seen, it's been 0.
I heard as of November, it hasn't happened once yet.
So that's the kind of the big stat, right? Like nothing's really come out of it in that regards. I will say too, 2 of the 7 wards, including Northwest Side, in the Northwest Side Preservation Ordinance, Alderman Felix Cardona and Gilbert in the 36th successfully passed to get their wards out. So good start.
But they're a very small sliver of that.
True, very small. You're right. They were, but I think it's headlines,
Yeah.
right? And it's maybe a step in the right direction. Does this mean this won't still be a pilot program in other areas? I don't know, but it's what happened, right? And ultimately, this is still in effect. It has been withdrawn. It's going to continue to be something that sellers and brokers need to, consider. So the bull prediction was kind of half right. Prices just, didn't follow the rest of the city, and inventory's down.
Well, that opened up the door for South Shore then too, for that to pass then.
Yeah. Well, the other thing you said, tenants haven't exercised the right, but what you don't see on paper, if I was a tenant, I'd be like, cool, I'll sign your paper, $3,500. So, random number, right? Like you create a situation of leverage, like whether, and it's an unintentional consequence, but like.
And it's funny because Jake and I were working on a deal right around the time that we did the podcast last year, right when this started. And we actually, I discussed this specific case with Bree Schmidt, who's, you guys are probably aware, has been leading a bit of a charge on, fighting back against this. And she's asked for, stories of how deals went and everything like that. So we had a deal that was in the ordinance zone. It was in East Humboldt Park, and the closing took a very long time. The seller's attorney did not realistically know how to handle it. Kind of took the approach of, we need to be way more cautious rather than, just letting the guidelines that were on paper, guide us to where we needed to be. They were checking in with the city to make sure that we were good to go and waiting for a response rather than just saying, hey, we've fulfilled these requirements, so we're confident that we can move forward. And we had, again, this is anecdotal, and I can't say how any other of the transactions have gone, but we had a tenant that did exercise their right of first refusal, but then did not follow it up by getting a pre-approval, did not do anything else. And these rents were very low in this building. It was a building that needed quite a bit of work. The owners were planning to do some of that work and raise rents. So I understand the tenants not being happy with that. But at the final walkthrough, the tenant told us that he had never planned to ever do anything, but he realized that by exercising his right of first refusal, that he was able to delay the sale and have a longer time of having lower rents. He openly said this to us without us discussing the ordinance with him at all. He seemed to be aware and did this intentionally. And that is something that I didn't even consider last year. I don't think, Jake or I even thought about that being a possibility of them just intentionally delaying sales. But that just opens up another door. And so that is all stuff that has complicated this even further. So maybe nobody's successfully purchased a property, but I wouldn't be surprised if there were a couple other cases of tenants realizing some of the leverage they had in that regard and delaying sales a little bit.
On the flip side, I know of your sales reported, 2 of them didn't even know about it. I asked them like, oh, you went through all that? Like, they had no clue. so there is, so ignorance is bliss sometimes for some of these people. I don't know the ramifications are if they got called out now, but it's kind of messed up how, it's so normal to us to know, but a lot of everyday people aren't in the same circles or on the same scrolls as we are. So,
Yep. All right, let's move on.
Hold on. One more thing though. And this is crazy. In New York, I guess this makes this look a little better. In New York, they passed something. I'm not sure which borough. It's not in all 5 boroughs. It's in one of them, that instead of giving the tenants first right, the city has the first right of refusal. And it's 30 days and it's similar kind of structure, but it's the city. And it's both before, right, when you're thinking about going on the market, and then again, once you get a contract. So it makes ours.
He's got to be the worst property manager
in
the world.
I'll send you guys a link. Somebody from New York shared it to me saying you guys got it good. Like, this is way worse. So that it could be worse.
Yeah, I mean the one scenario that I keep coming back to is like that older owner. Like, this is a lot of hoops to jump through. Yes, you can hire people to do it for you, but like we're in the game. We all know this. All right, this is what we got to do. But like, this is like complicated, and like you can F it up 100 different ways.
Yeah.
And if you try to wait for the Department of Housing to give you a green light on any of these steps, nothing will ever happen. Nothing will happen.
Title, like when this first came out, title companies like wanted that, right? Well, that was like holding up closings. It's like, dude, we're not going to get this. Like, it doesn't make any sense. So, all right, let's move on though. We got a lot to cover. We also talked about the move back town. Mike, I think we got this one right.
Yeah. So we got this right, marginally. Jake's cited some of the stats of how much real estate has gone up citywide. And there are a lot of different sources for where you can get appreciation statistics. But based on what I found in what is considered the loop of Chicago, we saw a 2.2% rise in sales prices. Now, versus the rest of the market, that is not as much. But what it does tell me is that the prices did increase. Now, that has to go along with increased sales, right? So we actually did see increased sales. So we had 3,921. That includes detached, attached singles, and multifamily. and that was in 2024. And that jumped to 4,132 in 2025, which is a 5.38% increase. Now, the tricky thing is there's got to be a buyer for every seller. But what that does tell us is that while we didn't necessarily see, a bunch of vacant units that are being, suddenly bought up, it does tell us that there was a little bit more demand, that a lot of stuff that may have sat on the market in 2024 was being bought at a slightly higher clip in 2025. So there was a little bit more demand for buying in what is considered the Loop, which does stretch a little bit just under Lincoln Park. And the prices did increase a little bit. There's still going to be more demand in the western suburbs. There's still a little bit more demand in some of the more outlying areas like Wicker Park and Bucktown and Westtown and all of that. But we did see a jump. And so I would say that that's a win.
Yeah, I'll take it. I think he's right.
Yeah.
Jake, anything to add to that?
When we talk to buyers comparing Gold Coast, River North to Wrigleyville, Uptown, Edgewater neighborhoods, we continue to echo the same, like, if you want a better bang for your buck, you go closer to the Loop, right? These prices still have not fully recovered in some little niches, neighborhoods, towers, if you will, from 2019. So,
Yep. Cool. All right. And the last one was more of an observation, but just that we were talking about the 1901 project.
Yeah, I'll make this one quick. As of the time we recorded last year, the city council had not greenlit this. It had gone through just as like a zoning committee, and they greenlit it February 2025. So it's a go, at least phase one. And then subsequently after that, it sailed through the zoning committee. So there's nothing really holding this up anymore besides the operators in some regards. And then securing maybe some more land and getting some of the contractors that are actually going to build some of this stuff. But what I kind of failed to find, and even with some like Google mapping and looking physically, is like it was supposed to break ground in the summer, but nothing's really broken ground, right? Like they've quote unquote started, but I think that start definition is like plans, drawings, things like that, getting bids and such. So we'll see, when that actually does break ground. But first things to come as a rehash are a 6,000 seat music hall, public plaza, boutique hotel, and a parking structure. These should all be done supposedly by 2028, which probably means like 2030. Mm-hmm. But, it's moving forward. There's nothing else the city really needs to do to stop this. So,
yep,
green light.
They bought, I think, 6 more parcels
in
2025.
Yep. So what do you say to like your buyer who's like, hey, I want to buy up over in that area? Because I hear about the 1901 project.
Yeah. My first reaction is typically that, the pricing has already built this in. But if you're looking at something longer term and, you believe in that natural push west, like, yeah, go for it. Especially those looking in like East Garfield Park, Tri-Taylor. Like, it's just, we talked about this last time, like the proximity to downtown and 290 and the L is just so stinking good that, I have a lot of confidence in it. So I'm very bullish on it. But if you think you're still going to get a deal and you're going to see 20% appreciation and probably not a spec buy at the moment, right? More of like 10 to 15 year type. I want to be in this area.
Yep.
Yeah.
All right. It's good stuff. All right. So that's our recap on 2025. What is in store for 2026?
I'll go for it. So I'm going to kind of take a very similar route with my first prediction as I went with last year. The current administration seems to have ideas. They seem to want to be in control of a lot of stuff that happens. And so I do think that coupled with, what is being considered an affordability crisis, when it comes to real estate, you guys go on the internet, you see every meme about how millennials and Gen Z can't buy property, that nothing can be bought. There has to be a solution for it. And if we had made a prediction in early 2023, as rates started to go up, that, hey, FHA is not going to pass self-sufficiency, which means on 3 to 4 units that 75% of the rental income has to surpass the mortgage. If we had seen that and we had made the prediction that, hey, the government's going to come out with a 5% conventional product, that would have been a pretty bold prediction, but they did it in late 2023. So I think that there's going to be other similar steps that have to be taken to combat this a little bit, because we have a pretty stagnant market in a lot of the country. Especially here in Illinois, we're still down 60% from pre-COVID inventory. There's not a lot of properties that are moving. And something that I'll discuss a little bit later is we're seeing a lot of resistance with mortgage rates. And there's a couple of different macroeconomic factors that go into that. So what do we do with that? How do we combat that? So I'm going to make a somewhat wide net prediction that we're going to see one of the following three, not all three, not a specific one, but we're going to either see portable mortgages, which I'll discuss in a second. We're going to see 40 or 50-year mortgages, or we're going to see expansion of assumable loans to include conventional. And so what is a portable mortgage? That's the first one. We all kind of know it here. And there are different ways in which portable mortgages work. But basically, the general concept is that if you have a mortgage for 3.5% currently, you can move that mortgage to a new property. Now, where it gets complicated, this is used quite a bit in Europe and different parts of the world. Where it gets complicated is, hey, let's say I have $350,000 left on my current mortgage, but I'm buying an $1 million house. And let's say we're putting 30% down. So I need another $350,000 of mortgage. How does that blend? Do you get, a perfect blend of, hey, if your rate's 3, current rates are 6, do you get a 4.5? Likely not. That doesn't seem how the banks want to operate this. So there's a couple different ways that this can blend. But basically, that is something that Trump has discussed that they're looking into, that I think could potentially be instituted as a way of breaking people out of their current interest rates. Because there are people that maybe in 2020 bought a house for $500,000 with a 3% interest rate, and maybe it was a starter home in the western suburbs, Naperville or Hinsdale. Not that you can buy for $500,000 in Hinsdale at all, but maybe it was a small Cape Cod or something. But the idea is there. Maybe you bought a very affordable small home, and now we're in 2026, and maybe you were having your first kid in 2020, and now you've got 2 or 3 kids, and you really need to get into a bigger house. You just can't get all of your kids raised in an 1,800 square foot house, but you feel trapped by your 3% interest rate. So that may be a way of you having a softer landing, and that'll put more inventory into the market. So that's huge. The second potential is a 40 or 50-year mortgage. That one's a little bit more straightforward. The longer your amortization schedule, the lower your payment. Is that necessarily good for the borrower? That's a debate because you're paying a lot more interest over the life of the loan, but it does allow you to purchase a property and not be, kind of handcuffed to just your mortgage with no ability to live outside of those means otherwise. You won't have any other money left over if you can't afford a 30-year mortgage, but maybe you can at a 40 or 50-year mortgage. And then the last one is assumable loans. There's a lot of people that, want to sell their property, like I just discussed, that have a low interest rate. But at current, realistically, you can only assume FHA, owner occupied, or VA in general, owner occupied, or as an investor. And there's rules that go along with it. But if we have some expansion of assumable loans, it will allow people to at least move properties to new buyers that, maybe getting a better deal. I think that would cause some increase in prices. I think that there are problems with that, because if you're saying, hey, I'm going to sell this property with a 3% mortgage attached to it, you might have gotten $700,000, just throwing out a random number, if the current interest rate was what the buyer was going to get. But now you can ask for a premium and say, I want $750,000 or $800,000 because there's this, low interest rate attached to it. And then there's also having to assume a large amount. So there may be a blend of financing similar to the portable mortgages. All that being said, I think that one of those three is going to happen in this year, because there has to be something to combat the fact that everybody's sitting on their properties.
Yeah, it's you need to entice everyone keeps saying like that 3% mortgage, that debt is an asset. And now you need it so it can be transferable in one of those, like not in the middle one, but in example 1 or 3. The biggest obstacle I see, besides like the banks, like all the logistics of it, is there's been so much appreciation over the last 5 years. In any of these situations, it's going to be a large down payment, as you alluded to.
Yeah.
Right. In the portable example, or if you're going to assume, even if they did 100% financing 5 years ago, like you're still probably coming to the table with 200 grand, 300 grand, whatever, some big number. So like, I think it'll create opportunities for some, but I don't know how much it actually helps affordability.
So if you had to pick one of those three from happening, doesn't affect your prediction. What would you think?
Like, what would I want to see, or what
Which
I
of
think
the
will
three?
happen?
Which ones? Yeah. Which you think?
I think the assumable would probably be the best.
Yeah, because you can get a gap loan for that delta, right? Because if the
Correct. You
assumable
can do the
if the
HELOC.
equity,
The
if the
portable,
person
I
has
don't
a
know
lot
how
of
that would
equity
work.
from 4 years ago, that's the issue naturally, right? Like, oh, I'm going to get a 2.75% rate, but I had to put $300,000 down on this, $600,000 2-unit.
But we've had
you
some on
can-
the program, and I forgot Wagner was talking about the one guy.
Oh,
who
with
does it as well.
Rome.com.
Yep.
Yeah.
So like there's examples there. The portable one, that's a first position lien. Like I don't know, I don't know how that would work.
So, and there's different ways that it can work, and it may not be first and second position. It may be that the new bank is taking on the previous loan and, like I said previously, blending it with the current rate. So maybe you had a 3% loan, you don't want a 6% loan, but you're blending it into a 4.5% loan. That kind of acts as its own new loan. So I think that may be the most likely because it is more beneficial to the banks. An assumable loan is kind of consumer to consumer. Like if you can come up with the money, it may create a secondary market for second liens, which second lien holders don't like to be second lien holders. So that one seems a little tougher, but I just think that one is the more likely of the three, which is why I put it first on my list. I think that the 40 or 50-year mortgage is possible, but it is so disadvantageous to the consumer that it'll raise a lot of red flags when they try to push it through. But the portable mortgage is kind of a happy medium. Like the consumer gives up a little bit. Like, yeah, I'm buying a bigger house and my interest rate's going up a little bit, but it's not so much sticker shock of, my rate doubling and I'm buying a more expensive house. So I might have a $3,000 payment that goes not just to, $6,000, might go to $7,000 or something crazy like that. But if you blend that rate, you gotta, blend it and get a slightly worse interest rate. But again, it's not so bad and your payment isn't going up so much that you can't do it.
Yep. Yeah, I think one of the bigger topics on the national level is the age somebody buys their first home. Like that's crept into the 30s, right? Yeah. Like we bought in our young 20s. Yeah. Like that, I think, is the problem they'll try solving. And I think you're 40 or 50. I know that's not advantageous to the buyer, but that will put that into being realistic. That's probably the easiest push as well to make, because that, I imagine just someone like Guaranteed Rate just has to come out with the product to get that started, right? Like, I don't know how much.
If it benefits the lenders and the banks, it's probably the most likely to come out, right? Like, because they just have the most political power.
But
right?
that now puts your 25-year-old back into the position to be able to buy something that's already overpriced because inventory is so low.
Well, all this is just like pulling little levers. Like supply is the answer.
Yeah.
Right. Like that's the real answer. These are all just like little, kinks that help a few people. But like the real answer is we need more building. Like we need to build.
I saw some of Lennar's building like 900 square foot, like tiny, or like 800. It's like 750 like micro homes. I don't know if you guys seen that, but like we need more of that, man. Yeah. We just need something.
So, all right, move on. Which one do you guys want to cover next here?
Yeah, I'll keep speaking of supply. We'll transition into something cool that's happening, but we'll see what the true effects are. So on April 1st, 2026, Chicago is expanding the ADU pilot program from the areas it's been in for the last few years to the whole city, besides downtown. And I don't know the exact definition of downtown, but I assume this doesn't include the loop, right? So to your point, the idea is to create more inventory, more rentable units. But I think the prediction that I'm making and what we already see with a lot of buildings in Chicago that have bonus units in, granny flats or things that are kind of non-conforming or legal is that despite this move and despite that it's going to be a kind of a nice marketing push and maybe there'll be a few more permits for this, that it's not going to lower rents in the short term. And it's probably not going to result in some crazy demand boost for these units that's going to result in like 20-25% appreciation, right? Like I think it will help. I think it's a nice marketing, not a ploy, but it's a nice way to highlight the upside of a big lot in Lincoln Park that has space in the back, right? Where you couldn't before, or certain neighborhoods that have, the upside where the broker can kind of give you the pro forma of like, this is what you can make and this is what's, possible. So I think that's good, but I don't think it's going to make the splash that we want it to make. The numbers from what we've actually been able to convert to ADUs, there was about 400 added since 2021 with the pilot program. It's not that many,
Nothing.
right? Like it's really a drop in the bucket. So we're increasing the eligible parcels from 116,000 in the pilot zone to roughly 245,000. So more than doubling the eligible by right parcels, which is the multifamily zoned parcels, right? Parcels. The big kind of question is, will the single family owners take advantage of this and build ADUs and coach houses above like the garages, right? Because what we've seen in the garden and these in-law spaces is like, it's not worth the risk typically unless you're in a really A-class neighborhood where the price per unit is very high. If you're in a Portage Park, West Pilsen, B- where like, the price per unit's about 200, 250K, spending $200,000 to redo to code, rip everything out and put that back into that space, it doesn't make a lot of sense right now, right?
Correct.
So the council's given the green light. This is already happening. You're able to add ADUs to anything without a special zoning in the entire city, like I mentioned. So they're by right allowed in multifamily zones, but there's a lot of aldermanic power here, right? Aldermen can choose to opt in or out blocks of their ward that are zoned RS,
Right. They
right?
can break it down even parts of their ward even.
That are zoned RS.
Oh,
If you can do it by right if you're multifamily zoned.
Yeah.
It's the RS that they're like, this block's a little too.
Which is every 2 unit through 4 unit.
Gosh,
Like, regardless.
yeah.
Correct.
Jeez.
Correct.
It's everything we're talking about.
Right.
Okay.
So if your rental property is a single family zone, you'll need to check with your alderman still to even if they're opening up for ADUs, right? And you're going to have an owner occupy requirement in all of these. It's TBD if they're going to stick to that for the 1 to 3 and the 4 units. What I've looked at, they keep focusing on 1 to 3 units. This is odd, so I don't know if that means the 4 units will kind of have it by right. But the point is like, yeah, good for house hackers, good for people who are going to be there, boots on the ground, see it happening, maybe not take on some of the project themselves, but investor wise, I don't think this is going to be a big draw, right? Because there's just a lot of barriers still there. Tom, you mentioned we were talking about this earlier. You also have to use a contractor that has an apprentice program, correct?
For the coach house.
For the coach house. Okay,
Not for the,
all right, good
and
point.
it's different for the garden. I don't understand why, but that's the rule.
Still, what the hell is that, right? Like, there's only, from what I researched, there's only 25 companies that have apprentice programs in the whole city. Out of I don't know, there's got to be hundreds of thousands of contractors that could do this work that are registered with the city. So, more red tape, right? But our hope is that like we see appraisers and lenders see this as a step in the right direction of they're appraisers, lenders are very focused on protecting themselves. They go with, kind of what's happening in the market, right? So if the neighbor did it, they'll do it, right? If they appraise the 3 unit down the street that has a legal ADU and they count that income, right now, currently Freddie and Fannie don't count that income for 2 to 4 units, but they will count that income for a single family. Freddie and
Which is
Fannie,
crazy.
which is kind of crazy. But FHA, which is a little bit more vague, I have to confirm this, but as of right now, from what I know, FHA will count the income for an ADU in a 2 to 4 unit. And they could add that income towards your pre-approval. So it just increases buying power. So again, if we see this kind of catch on and we see lenders say, oh, well, we did it down the street, or that rental, that ADU, comp down the street got $1,600 or $2,000 a month rental, pro forma, they'll use that income. So naturally, hopefully, this raises some buying power. It's just gonna take some time.
We'll see how this plays out, but you have to almost, and I'm afraid it doesn't, create like this tipping point for if you have your house hacker and you have that non-conforming, it's like, does this make me want to actually legitimize it? Or is this just like, I might as well stick out?
On a spreadsheet, it never makes sense.
No, it doesn't.
It'll never make sense for that person to go do it. Like the only person who makes sense for is someone like me who's coming there and gutting everything anyways.
So this tips in the wrong way.
Pretty much. Like, yes. Like it's,
Yeah.
I don't, they missed the boat on this.
I
Right, like
think
it's well intended, but like it's taking care of that. Now we are selling it short because I'm going through I'm asking for 2 different zoning changes right now, and it's a 4 or 5 month process. It's 5 or 6 meetings.
Right.
It's paying the zoning attorney. It's the holding costs. Like I'm putting 30 grand or whatever for each situation at risk, and I might not even get my approval. Like that's the process right now. So this does solve that
For
part of
developers, this is definitely
that
far more than the mom
this
and
solves
pop.
this
house
solves
hacker.
that part of the process, but it does not solve the building side of the process, and like it just doesn't make sense. And it's for people like us to utilize it. It's not that like that house hacker, like it's not gonna do much for them.
So real estate developers, professional rehabbers like yourself, and there's only so many of you though. So you guys can only take advantage of so much of it. And there's so many house hackers that could.
And you can only do it in areas where, as Jake mentioned, the construction cost justifies the unit.
Right. So it'll probably have
Right,
immediate.
like, so like in Lakeview, it's great. Like
Right.
I haven't seen the stats, but I can almost promise you the most ADU permits happened in Lincoln Park, Lakeview. Like they were there,
Right.
not in
So
other
developers
neighborhoods.
like you might start to tell your brokers in your sphere, like, hey, maybe you change your buy box slightly, or you are willing to pay a little bit more for some of these lots that are a little bit bigger in Lakeview, or you know what I'm saying? So like it might help in that sense. It might help sellers in those areas that have lots and buildings that have more potential for ADUs if people believe that this will get easier, right? That's a big if. We'll see.
Yeah, and the Northwest Side, none of the aldermen are opted in. Like I called around, like no one up by me in Edison Park, Norwood Park, Portage Park, none of them are opting in.
Yeah.
So like that's all off the table. So, all right, what's next?
So I'm going to go ahead and talk about a very similar topic to what I talked about 2 years ago and last year, and I'm going to take the opposite stance on it. Unfortunately. So 2 years ago and last year, I took a pretty bold take that interest rates would dip quite a bit. And there were actually a lot of factors that I felt supported that. And one of the biggest ones was that there was a massive spread, a historically massive spread between the 10-year treasury and where mortgage interest rates were currently sitting. And that was kind of peaking around, 2.8 to 3%, depending on, every lender has a different rate sheet and all of that. But that's kind of where we were sitting. Today, we are much lower than that. We are closer to a 2% spread between the 10-year treasury and the current mortgage interest rates. So, why would I then predict that interest rates are not going to go down more than 0.5% this year? That's the take that I'm going to get. I was considering a couple of different numbers, but I'm going to say that they're not going to dip more than 0.5% from where they're sitting today, which depending on lender is 6%, 6.25%, 6.125. It all depends on what your personal credit is and all of that. There's a number of different factors, but we're sitting somewhere around that 6% mark. So again, why is this the case when the Fed is cutting the rate and, it seems like we are trending in the right direction to where mortgage rates should fall? Well, it gets very, very complicated, but the mortgage rates are not directly derivative to what the Fed does. The Fed lowering the interest rates several times in the last few months has actually not decreased the 10-year treasury at all. The 10-year treasury has actually gone up. And as of this morning, when we're discussing this, it'll be different when the pod actually comes out. But we are sitting at about 4.168. At the beginning of December, we were hovering around the 4% mark. So there are a lot of factors, and those factors are not looking good. So the federal, the Fed can do what they want, but the investors that are investing in the bond market are not valuing bonds to the degree that we want them to. So the 10-year treasury is not going down. The federal deficit is increasing at a larger rate than it was last year and the year before. So how does that play into it? Well, investors need to get a certain amount of return when they're buying these bonds. And when you're looking at a long horizon, when you're looking at a 10-year treasury versus, a 2-year treasury, you're going to have to demand a slightly more premium for putting your money out that far. And when the federal deficit is increasing at the rate that it's increasing, investors are baking in more inflation than we're currently being quoted in the current market. So they're saying, hey, in order to buy these, and the fact that we're having a larger supply of bonds being introduced into the market to feed into that federal deficit and pay for that federal deficit, in order to invest in bonds, I need to get a larger return. So the 10-year treasury is going up, and because there is a historical spread between the 10-year treasury, which, as I talked about last year, is about 1.8%. So we still could see a little bit of movement due to that spread. But because there's a historical spread between the 10-year treasury and the mortgage rates, if we don't see the 10-year treasury go down, we're going to be hard pressed to see the mortgage rates go down. So even though the current administration wants to see the Fed lower the rates, that's not necessarily going to get us where we want to be. So unfortunately, I do think that we're going to be in a situation where we have a lot of stagnation this year. Now, will that affect buying? I actually don't think it will. The NAR is projecting a 14% increase in buying activity this year versus last year, not in terms of sales price, but in terms of transactions. Now, the NAR is biased. They want to see that stuff. But I think that there will be so much normalization of, hey, that's just what the rates are right now. So this is what I'm paying. These are the houses that I can afford. And then there's also going to be social pressures that I kind of talked about when it came to the portable mortgages and things like that. People have been locked into their interest rates for long enough to where something's going to burst. I have to move for X, Y, or Z. And so for those reasons, I do think we are going to see an increase in total sales, but I just don't think we're going to see the movement in the rates, even though they've been, quote unquote, higher for a little while. I don't think we're going to see the movement that I was hoping we would see the last 2 years.
Yeah.
I mean, compared to, I listened to our last year's pod, and when we were sitting here talking about rates, we're at 7.
Yeah.
And we're at 6, just over 6 now. I mean, so again, back to the normalization comment. Like I personally just, locked in a 6.35 for a pure investment 3 unit. To me, that's not bad. Last year was 7.5 for a pure investment so we're starting to see, again, a little bit of normalization, people being like, yeah, okay. If rents are going up, I can deal with this. So I think I agree with the velocity and the volume going up. And, I do think there's this, like, a lot of the news is talking about a psychological, like, once people see that 5 number, like a 5.8 or a 5.7 rate, there'll be a lot of unlocking of supply. But I don't know if we're going to get there.
Yep. Going back to the 10-year treasury, what would have to happen to cause it to drop? Right. I understand exactly how you laid it out, that, the investor is expecting a higher return, and we're issuing more. So there's more supply, the opposite of the housing. How do we reverse that? Or should we, or is this just what it is and we live with it?
So
But is there a scenario, like, even if it's unlikely, what's the scenario where the 10-year would actually drop?
There's a couple of different scenarios. So the lack of better options could be one. So right now, you can, get 4.168 return on buying a 10-year treasury, but there are still people that are saying, I am bullish on the stock market. I can get a better return out of the stock market. If people start to pull themselves out of the stock market, which we have seen it go backwards the last, month, 2 months, there's been a downward trend. Tech has been so high for so long. There's ways in which we can see investor mindset change depending on what they see as a stable and somewhat safe investment. But then on the other side of that, if we can decrease the federal deficit, I mean, that would be the biggest thing, because if we can see a long-term, projection to where the U.S. can actually satisfy its debts, where we're not afraid of, getting a lower credit rating, which actually happens for an entire country if people aren't aware of that. The U.S. had their credit rating reduced for, I think, the first time ever, I want to say last year, because our federal deficit is continuing to grow. If we can somehow reverse that trend and we can actually reduce the federal deficit and see some growth there where we're making more than we're spending, that would be a lot more confidence that, we're actually going to outperform inflation and that things are going to get a little bit better. But you have to remember that you have money, and when you have money, cash money, that it's going to lose value at the rate of inflation. So you need to outperform that by a certain amount to be happy with it. And right now, I don't see that happening. There are theoretical ways in which it could happen, but I'm struggling to see that happening, at least in the next year, with the current macroeconomic environment.
Yep. Good stuff there. All right. Jake, bring us home with we have a bunch of brand consolidation in the space. What's going on?
Yeah. So most people, unless they weren't tuned into really anything real estate this year, saw that Rocket Mortgage purchased Redfin, just maybe because of the color's red, but I'm sure there's more logic to what they want to do there. And then also the Compass Anywhere merger, which is going to create a giant, and it hasn't been finalized yet. So it's going to be finalized this year, but it's kind of inked, if you will. But what we're seeing is the acceleration of this. Like it was never to the extent where the top 3 brokerages handled more than about like 5 or 10% of all real estate transactions. It was still a very small type of environment, right? In 2024, the top 3 brokerages accounted for 17% of sales volume, and the top 10 accounted for 42%. So what we're going to see, in my opinion, is this just starting to get bigger and bigger, right? Will it ever be, 100% with the top, 3 firms? Probably not. But we're going to see this kind of like consolidations, like the airlines, right? They're going to gobble up the smaller ones. And what does that do? I mean, TBD what exactly happens to the consumer, but hopefully, and I think the intent is it lowers fees to consumers, and it tries to keep them in one platform with maybe 1 or 2 different advisors instead of having a real estate agent, a lender, everybody in there kind of on their team from all different companies, right? So I think this is the way things are going. I don't know who's going to buy who, right? Mike and I are with a big company called EXP. It could be someone like EXP. We don't know what they're going to do, but to compete with the Rocket Redfin type situations, and we know what Compass wants to do, right? Compass wants to control inventory. They want private listings.
Yeah.
They want to handle the client in a not totally different way, a different way than, what we've seen and what some other brokerages kind of agree with. So I'm curious to see how that shift goes. And I think it's going to be the platforms, not just being like, we have this many brokers, but I think they're going to try to standardize their behavior, right? I think they're really going to try to keep the buyer, whether it's Zillow or Redfin or whatever, they're going to try to keep you in one platform the whole way, right? What does this do for the buyer's agent? What does this do for the buyer? I think, fees and commissions will start to evolve. I think it'll be more of, we'll see more flat fee situations. We'll see things like commercial pay more, or things where value reflects what you get, right? Or what you pay is kind of what you get, right? So, this has been kind of on the writing on the wall since the NAR lawsuit like a year and a half ago. But I think despite a lot of brokers like to get on Facebook and Instagram and be like, the average buyer's broker commission has gone up in the last, year. That's true, but prices have also gone up too.
Yeah,
right? Like there's
you
other
get the percentage of prices that are increasing.
Right.
Yeah.
And I also, what they're not saying is there's a lot of brokers exiting the market. So yes, those agents that are still in the game and are good at what they do, yeah, they can command more. So I think those headlines are a little, skewed. So I think we're going to see more of that. I think we're going to see this Compass thing heat up. Something's going to burst with Zillow eventually, because the clash with Zillow, Zillow's income depends on this sharing of IDX feeds, right? They want to control that flow. But I think in 2026, especially with AI, especially with just this tech forward thinking we have going on in general, it's going to be interesting, and I don't think it's going to slow down at all.
Is there rumors, or do you know anything about Zillow buying someone or merging with someone?
No, there was this I think this is just people trying to grab attention, but like there is this rumor that Google would buy Zillow, right? Because
They're listing now too.
this is a segue into like the second part of this topic and prediction, if you will, is that Google starts to become the first default stop for your home search, right? Not in the sense that they're going to be a Zillow clone or they're going to take Zillow out of the mix, but they're going to be the light portal that kind of captures your browsing, and then something happens after that, right? Like then that agent you connect with, or that listing agent, then pushes you some direction, whether it's Zillow or Zenlist or some type of platform, right? So what's interesting now is Google has already, this is a few weeks ago, they made an announcement, they're entering the real estate market in the sense that they're showing new home listings in a few select cities, and one of them is Chicago. So by the time this podcast comes out, if you're in the city, I think it might geolocate you. If you go to, and it's only on mobile, you have to be on your phone. If you go home sales in Chicago or home for sale near me, it's going to show you a few homes on the top, just kind of like, you know, it would if you were shopping for your watches or something like that. And they can do this because they partner with a company called Come Home, which is owned by Home Canary, who has licenses in all 50 states. And they're kind of saying, hey, because Google is technically not allowed to take like a listing from Mike and I's and just push it out there. That's not legal. But what they are allowed to do is if you're a brokerage that's licensed with that local MLS in, let's say, Chicago, and we check a box in the MLS that we allow it to go on internet listings, they can show it. But Google is not a broker yet. I don't think they're ever going to be a broker, but I think what's going to be very interesting is what they do with this, because if you go on the sites or Home Canary and how they've announced this, it's very cryptic. It's like Google is testing this. And that's literally all they say. And there's a couple asterisks of like, you know, what that's going to say. So I think what's going to probably happen is they expand this test market from right now Chicago, Denver, and Austin. I think by the end of the year, it's going to be in a few other places because they've been approaching these MLSs supposedly directly being like, hey, is this cool? We're just kind of testing. And they kind of need to get that permission maybe first. But I think eventually they get some type of blanket, you know, pass because they're freaking Google. And they expand this. They start to eventually charge agents some type of advertising fee, right? So Zillow's stock plummeted. It went down about 9% when this was announced a few weeks ago. Right away. I think EXP's been down a little bit too. Unfortunately. So, and they're going to expand this into kind of like request a tour, contact the agent. Right now, if you click on those listings, it does show it goes directly to the agent in some way, shape, or form. They're not like capturing that lead yet, but they're gonna find a way to monetize that. So, it's interesting, man, especially when Google comes into something like that. Like they did this with flights too. So a kayak still exists, but you know kayak because of brand recognition, right? You know kayak because you have the app. So I think Zillow will no longer, they're not going to be able to rely on that SEO just being at the top of a Google search. They're going to really need to push brand recognition, right? All these, whoever it is, Redfin, they want people that are going to download the app now. Their SEO is going to go away. I think Google's just going to be the funnel.
Yeah. So I have mixed thoughts on it. One, like it does feel good. Like the more information you get in front of a consumer, the more educated that consumer can be, right? So this should, in theory, be good for people to be educated. I think what it does for brokers is you got to like one or two routes. You need to be awesome and provide a ton of value and like prove your worth, or it's a cost play, and you can't get caught in the middle just being average. You need to be providing a ton of value, or like I said, like it's high volume, low cost, flat fee, and like nothing. Most businesses are like this, right? You got to choose a route here and can't get middled.
Yeah. What's the, like Zillow's model is charging agents to, you know, when you click request a tour, they skip the listing agent. They go right to these agents that are Zillow Flex agents that are paying for that lead, right? So will they undercut Zillow? Like what's going to happen? This is all part of that evolution of like, what is the buyer's agent adding in that case? And does the cost per lead go up as a result of this?
Yeah. And what I think is interesting here is, you know, whether or not, you know, what angle Google takes on this, right? Like when you look at Google Flights, maybe you have, but I haven't used Expedia or Kayak or any of those in years because I don't need to. And what does Google get out of that? Ad revenue. You know, maybe they're getting a percentage if you click through there, but I don't think so. I mean, I see a United flight on Google Flights, and then I go over to my United app. Right. So what is their play on this? I can't imagine they want to take on the liability and risk of being a brokerage. I think that's, I don't want to say fully out, but it's most likely out. But to me, it reminds me of, you know, if you've ever watched The Voice or any of those shows where all of a sudden you've got, hey, I'm a songwriter. I've written all like these 10 famous songs, but I can actually sing, and I just never did it. Google's all of a sudden realizing, like, hey,
this analogy is great.
You for years and years, you've typed in homes near me, and other than ad revenue, we've linked you for free to Zillow and Redfin and Homes.com. when we could just be doing that exact same thing ourselves and just jumping ahead in terms of that funnel? Why would we push you off? Google has pay-per-click ads for, a lot of agents, but why not monetize that to an even greater degree by just saying, hey, we can show you those same homes. We'll figure out a way to do it. And then we'll go straight to the agents, and Zillow and Redfin don't need to exist anymore. Why would you need to use that when we can jump ahead of that when you're searching on us anyway? Nobody uses Bing. Nobody uses any other, you might go straight to Zillow or Redfin just because, it's habit at this point. But a lot of people are still searching on Google like, hey, I need a $700,000 house near me. And Google is just going to get ahead of that and start to, push out some of the people that are just doing what they can do anyways. And this may actually benefit your classic brokerages like, EXP or Compass or App Properties, because for us, why wouldn't we just go to Google and say, hey, yeah, we want to start to pay you for these leads. We want to get ahead of Zillow and Redfin. We want the consumer to come straight to you and then those leads to come straight to us. And they can probably do it for a lot less money than Zillow or Redfin are charging, and make all of that money on their own. They've already got the platform set up.
Well, I think this all comes back to AI, because Google's Gemini has really, they actually, where everyone thought they're falling behind, in the last 6 weeks, they've jumped ahead. And it's I almost feel like they've just been kind of waiting to see how everything's going to play out. And the whole AI thing is people are going to be using Gemini as the tool to find houses and talk to them as a personal assistant and all that stuff to help them find stuff. So they might have already been experimenting with that for a while, and that's the search that's coming up for it.
Yep. Cool. I'm looking through my notes. Did we miss anything? Very well done, gentlemen. Let's get to the wrap here.
All right. What's your competitive advantage? How have you guys been able to do this for another crazy year? I know so many others wish they could.
Are we both going to go? Yeah, we'll make it quick. I think if you'd asked me that same question 4 to 5 years ago, it was just hustle. It was I got a new lead on Bigger Pockets, and I'm looking, to buy places in South Holland. I'm like, let's pick up and let's go. I'll drive you down there right now. I think now it's Sphere though. I think now it's who you can connect your clients to is huge. And the fact that we're in a few masterminds, we just have our team, we have a couple of different WhatsApp chats, we have people like you guys. You ask me for a roofer, in the South Shore, it really just, I'll get back to you in 6 minutes, right? Things like that. Mark, I'm sure you get this leverage constantly, and that a lot of the value you add, but you have to it's a little bit chicken and the egg. You can't do that year one. You just don't have the connection. So
yep.
Sphere.
Cool.
Yeah. I mean, I think getting to the root of it, Sphere is great. That's how we've been competing more and more lately. But just getting to the root of it. I've said this before on previous podcasts, Jake and I both invest. Jake just picked up a property. I bought a property at the beginning of the year, and I just bought a 4-unit that closed 2 weeks ago. We are actively investing. Jake owns a bunch of units. I'm up to 31 units. When I go to somebody who's hey, I want to buy a 4-unit in Lincoln Park, and they say have you ever worked with investors? I say, not only have I worked with investors, hundreds of investors, thousands of investors, I am an investor. I own 31 units. I own this many properties within a mile of where you're looking. I already know exactly what a good investment looks like. And so us having that, boots on the ground experience of doing it on a day-to-day basis and self-managing just gives us this competitive advantage to where they don't ask any more questions. We don't need to sell ourselves any further. Nobody cares what brokerage we work for. Nobody cares our sales volume, even though it is pretty good. All they care about is that we can be both their agent and a mentor.
Trusted advisor is what both your answers summarize to.
Yes.
Yep. Cool. All right. One piece of advice you would tell someone that is yet to buy their first property here in Chicago.
So I would say just make sure that you know how to run your numbers. I know it's very, very basic, but I go back every single time I'm mentoring a new agent. Jake and I are both mentors within our brokerage, and people start working with investors. They just need to know the auxiliary numbers that go with purchasing a property, what your water bill is going to be. If there's a boiler, what your gas and water bill is going to be. You have to know all these costs that go into it. You have to underwrite vacancy. You have to underwrite management, even if you're going to self-manage, because eventually you're not going to self-manage and you're going to have to use GC Realty to manage your property. You have to write those in up front. You can't just say mortgage is X, and rental income is Y, and I'm making that spread. You're not. And so it's very important to make sure that you get good at running your numbers, because then from there, it's just about making sure the property's in good shape.
Invest in your backyard, right? I see a lot of buyers who are shopping initially and they're comparing numbers, apples to apples, for properties that might be in similar class neighborhoods, but one is 45 minutes away and one is 5 minutes away. Take that 5 minute away property over the 45-minute one, even if the cash flow is, I'm going to say, wildly different. Do not underestimate the cost of you driving because you forgot the Ring camera you're installing back at home, right? Like, these things just add up. Value your time a little bit more. I see people compare. I'm like, give more value to proximity than you think.
Love it.
What do you do for fun?
I just started playing pickleball because I'm a 42-year-old man. So that's cool. And hockey on the ice with my daughter as much as possible.
I am incredibly lame. I am still going to the gym 5-6 days a week. Every year that we do this podcast, I feel like I'm going to get less creative about my responses, because it feels like every year nothing changes at this point.
That's good, man. Routine.
Yeah.
Routine. All right. Give us a good book, podcast, or self-development activity you'd recommend to our listeners.
So I came, pretty unprepared for this, because I have read so many books and I have heard so many things recommended on your podcast. What I'm actually going to recommend is a website called Property Bots. It is a guy that I went to college with. He has a platform, and there's a million of these, and they're all probably, as good or maybe even better than his. But I think that at this point, there's a lot of stuff in podcasts. There's a lot of stuff that you can do, but getting ahead of the AI curve is going to be important, and automating a lot of what you're doing is also going to be really important. So, I've recommended books in the past. I've recommended podcasts in the past. Start to get ahead of the AI and start to use some of these online platforms. That's what I would say to do.
Good stuff.
This is one I just took off the shelf, The Almanac of Naval Ravikant.
Oh, I love that.
Yeah, I hadn't read it. Actually, one of the team members in podcast, I guess, Paul DeLuca, gave it to me I think 3 or 4 years ago as like a Christmas gift or something, and I just had never read it. And I had time to in the past few months, and it's one of those books you earmark a bunch of random pages for, because, and I like the book because you don't have to read it from front to back. You can skip to the last chapter about, wealth creation or things like that. So The Almanac of Naval Ravikant. It's a good one.
Paul was episode 398.
Oh,
Look
wow,
that
that
up.
was fast.
Look at
Good,
that.
Tom. Good.
Other than yourselves, name a valuable resource for Chicago real estate investors.
I'm going to rehash something that we did just mention. And now that you said it, I think another podcast guest, Jason, had already said it, but we recently have leveraged with Rome.com a few times. It's an assumable mortgage marketplace that funnels like FHA and VA listings that a lot of times these listing agents don't even know
Yeah,
are
they don't even know they're
assumable.
sitting on a 3%
These are not
loan.
manually added. These are pulled from the MLS and data sites, right? So when I've been talking to a few people recently, have been either frustrated about 2 to 4 unit market or what can I do as just a leg up? If you're a house hacker, with Rome.com, because that is going to pull out some inventory where you might be able to pay list price and it still work.
Yep.
Yeah, and I'm just going to piggyback off of that, because reach out if you want our electricians, our handyman, or all of that. And I gave Cost Kev the plug last year, but with the current market that we're in, with Rome has been something where we have a property under contract with Rome, and not only are they a marketplace where you can find these, but they actually do the back end work of negotiating and making sure that these assumables happen more quickly. So I'm actively working a deal with them right now, a Bronzeville property that a 1031 exchange buyer needed a great deal, and we found it on there just because we had met with them in Miami. And so this, investor is under contract at a 2.75 interest rate, and the seller is getting exactly what they wanted price wise, whereas they probably would have gotten 100,000 less, with the current interest rates. And then they're also handling all of the work. This one's with Mr. Cooper, if you're familiar with servicers, of talking to Mr. Cooper and doing all of this and making sure the assumption takes 45 to 60 days instead of 5 to 6 months.
And tidbit, you don't have to be a house hacker to assume VA. You could be a pure investor. That VA buyer or the seller who's selling to you loses that entitlement.
Yeah.
Yep. Boom. All right, Mike, Jake, thank you guys so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Yeah, I mean, reach out to us on all sorts of social media. We are, the Axon Group on Instagram, www.theaxongroup.com. Of course, our, personal Instagram and Facebook pages. I'm Michael Scanlon, Realtor. Jake, I'm not sure. Do you have an Instagram?
Not a real estate related one, but I have one. It's just jake.fugman. But info@theaxongroup.com comes to both of us. The easiest way to kind of reach out. We love to, kind of chat. This is still our niche. This is still what we like to do. And we always here to help.
Or reach out to Tom and I, and we'll make the intro.
Fine.
Boom. All right. Chicago Fact. Who are we playing for? Who's sponsoring?
All right, today's sponsor, Pulio Group. So Pulio moved to guaranteed rate. So today's episode is sponsored by Pulio Group, powered by Rate. And we are playing for Daryl Johnson. So Daryl, if myself, Jake, or Mike gets this question right, you get a $50 gift card brought to you by Pulio Group.
All right. Chicago is home of a lot of first things came out of the city. I'm going to name you 4. You're going to tell me which one of these is not a first out of Chicago. We are home to the first juvenile court, the first televised presidential debate, the first Ferris wheel, the first for-profit university. Which one of these is not a first out of Chicago? 3 are true, 1 is not. Juvenile court, televised presidential debate, Ferris wheel, for-profit university.
It's not.
This is an interesting one because we're playing for somebody. So
But we get 3 out of 4.
we get
Come
3
on,
out
we
of
get
3.
so,
Yeah.
I'm gonna start. I'm gonna say Ferris wheel's not the first.
No, it is. That's probably the one that's for sure.
That's what I was about to say.
Yeah.
Ferris
No
wheel,
one-
1893. The
Daryl, thank goodness Jake's not playing only
the
for you.
World's Fair debuted the
It's
Ferris
a
wheel.
circle. I feel like that was like prehistoric.
So
No,
we
no.
can absolutely throw that one out.
All right, I'll take juvenile detention.
Okay.
Speech. First speech, then I'll take that.
All right. Presidential
Yeah.
debate.
And my gut instinct says that we did have the first presidential debate.
Yeah.
So I will take, gosh, what was even our fourth one?
The for-profit university.
Oh, yeah.
I will say that we had the first for-profit university, maybe University of Chicago or something like that.
So that is the one. It's the one that is not a first in Chicago, and that is the answer. We did
Oh.
not have the first.
Oh, we
for-profit
did not.
University.
Okay, awesome.
Wait,
Well, I got it
wait.
right and
We got
guessed
it.
wrong.
What's up?
What university?
I don't know. Like I had to make up one that wasn't a first, so
Yeah.
I just did.
you
I have no idea where the first
Next
for-profit
time you
university
need like
is.
6 for us. Is that fair? But yeah, I like that.
I would have thought my gut would have been University of Chicago, set up by Rockefeller. So that would have been my thought. So
No, those ones out east, man, right?
no, in Chicago, the first one.
Oh, which
Profit
one
here.
is the first one?
Yeah,
here?
yeah, here.
Yeah, probably University of Chicago, right?
Now,
Probably
now I'm
older than
curious.
Loyola.
Yeah, I'm curious what the first one
If only I
is
had one of those computer
nationwide
machines.
and what the first is here in Chicago.
We'll leave it as a teaser. If you're interested, you got to reach out to us.
Or if you know the answer.
Yeah, or tell us the answer.
All right, Jake, Mike, Tom, thank you. Listeners, it's 2026. It's time to get out there, get networking. Make sure you're taking your dreams, your goals, your plans serious. Get out there, network. Visit straightupchicagoinvestor.com. We just updated all of the local meetups. Go on there. There's emails, there's contacts, there's dates, there's times. Check it out. Guys, thank you. Tom, thank you. Listeners, we'll see you next week.